Hi all, welcome to the next session on commodity derivative and risk management, and we'll continue with our discussion on different risk management products with respect to crude oil and refined product. And if you recall, in the last class we discussed about the swap contracts and with respect to how a crude oil refiner who is interested in buying crude oil and is fearing that crude oil price is going to go up, it will be entering into a swap contract. It will be as part of the swap contract, it will agree to pay fixed. And similarly, with respect to crude oil producer who is fearing that the crude oil price is going to go down, it will be entering into a swap contract where it will be agreeing to receive a fixed rate and pay a floating rate. So we took some numerical examples with different prices of crude oil, and we realized that with the swap contract, a crude oil producer will receive the fixed price irrespective of whatever may be the future crude oil price. Similarly, a crude oil refiner who is going to buy crude oil is going to pay a fixed price irrespective of whatever may be the price. Now, does it happen quite often? Yes, because if you recall, we started discussing with this particular information that swaps are one of the most often used derivative contracts by crude oil producing and refining companies. So 50.8% and 63% companies use swap, and also the ATF hedging information survey which was given by the Marketers Energy Group, that report also indicated that swaps to be one of the most common method of managing aviation turbine fuel risk. Now let's go to, we discussed about the swaps, and let's go to this one. This is a another interesting twist to the swap, that is known as an extendable swap. And please, one thing I would like to highlight here, that swaps are OTC contracts. It is entered in by two parties, so they have the freedom to modify the features of the swap. And I want all of you to just spend a couple of minutes understanding how Alston Energy Incorporation of Canada entered into an extendable swap. So what is the meaning of extendable swap? So Alston Energy Incorporation of Canada in January 2013 entered into a OTC contract as an extendable swap contract with a counterparty, and under this agreement, Alston, who is a seller of the swap, so who is a seller of the swap? So party who is fearing the price is going to go down. So that party will receive fixed and pay floating rate. So Alston's fear is that if he does not do anything, it is going to end up getting less amount of revenue. So it agreed to receive fixed and pay a floating rate and become a seller of the swap. And what was the price they agreed upon? They agreed upon the notional quantity is 100 barrels of crude oil a day. So 100 barrels of crude oil a day, and what is the fixed amount which Alston is going to receive? Alston is going to receive $98.5 US per day. And how much floating rate Alston is going to pay to the counterparty? This is very interesting. This is not the one day price prevailing. So this is the average of the daily settlement price per barrel of WTI light sweet crude oil for the same period. So the floating price is not based on the closing price on a given day. It is the average price over some period of time. So Alstom is going to receive fixed price of $98.5 US dollar per barrel, and it will pay a floating price. And standing today with respect to January 2013, if this contract is still valid, then you can see in the hindsight Alstom Energy is making good amount of money, because with the declining WTI crude oil price, Alstom will be paying very less price as compared to the fixed price. So $98.5 per barrel is much higher than the prevailing price of crude oil. So what is the extendable part of it? The extendable part of it, please see this one. This contract is extendable at the option of the buyer of the swap for 1 more year, ending December 31, 2014. Okay, so as of today, this contract will not be valid, because the buyer of the contract would not have gone ahead and extended its exercise its option to extend the contract, because crude oil price has gone down. But that's not the objective of discussion. The objective of the discussion is that how swap contracts can come in different form and flavor, as long as both parties are agreeing to have these innovative features incorporated into the contract. So the next set of contracts is futures and options. I have discussed quite often time, so I am not going to discuss this contracts at this point of time anymore. Now let's go to what are the collars or collars, whatever, however you would like to pronounce that. So what is a collar? Collar is nothing but a combination of two option positions. So if you recall, a crude oil producer who is fearing that crude oil price is going to go down, it will be mitigating that risk by entering into a long put position in a option market, or in a OTC market. It will identify a counterparty with which this crude oil producer will enter into a long put position, and the counterparty will take a short put position, and the crude oil producer will pay a premium for taking a long put position. So that is a typical plain vanilla put option. But in case of a put option, when the company is buying the put option, it has to pay a premium. So instead of paying the premium, simultaneously to match or not to pay a premium, the company can enter into a short call position at a higher strike price. So a crude oil producer who is long on asset or who is owning crude oil, its fear is that price is going to go down. Traditionally in an option market, it would have only entered the long put position, and but in a collar it will enter a long put as well as a short call position, but the exercise price for the short call position is higher than the strike price for the long put position. So K1 is your strike price for long put position, and K2 is your strike price for short call position. And similarly, let's say the consumer of refined oil. So if you have let's say a airline company which buys ETF, it fears that ETF price is going to go up. So normal case with an option market, it would have entered into a long call position. It would have taken a long call position, and with the long call position, it has to pay a premium. But if the company decides not to pay premium or reduce the premium outgo, it can enter into a short put position at a strike price of K1. So in this case, the long call strike price will be higher than the short put strike price of K1. So now let's focus on the how crude oil producer can mitigate its risk. So please see this small information which is given in the text box. So Sasol Limited of South Africa entered into a zero cost collar for 30% of its last quarter production of crude oil of 456 million barrels per the year 2011. Sasol took long put option at US 85 per barrel, US dollar 85 per barrel, and it simultaneously also took a short call option at an exercise price of 127.77. And when we are using the word zero cost, means the call premium and put premium are equal. So the company did not pay any long put premium and also did not receive any short call premium. Now how is the payoff going to look like? So the payoff is going to look like, so this is going to be the, let's say you have a long put at K1, short call at K2. So how does the payoff will look like? Payoff will look like, and K1 is less than K2. Let's say K1 is, in our previous, this case K1 is 85 and K2 is 127.77. So in that case, so it will be, the payoff will look like, from Sasol Limited. So this is your 85, this is your 127.77. This is your, please ignore this. So this is your spot price of crude oil. So any price less than $85, the company is going to benefit from the long put position. So without this short call option, it would be, its payoff would be like this. But with short call option, its payoff is going to be this. So if crude oil price is more than 127.77, it is going to incur loss. And if it is crude oil price is less than 85, it is going to get the benefit from the long put position. So this is a typical example of a collar strategy by a crude oil producer, or the same thing can be extended to, let's say, a refiner who is producing, let's say, gasoline or diesel and fearing that price is going to go down. So it can simultaneously enter into long put position and a short call position, and depending upon the negotiated exercise price, the payment will have a similar structure. So this is, this is another exercise I have given to you. You have airline company which is fearing that ATF is going to go up, and it enters into a long call position and simultaneously enters into a short put position. So long call position at US dollar 4.6 per gallon, and you have short put position at a exercise price of $4.1 per gallon, and the notional volume is 20,000 gallon every month. So you please find out what would be going to be the receipt and payment from this particular collar, and this answer to this exercise I am not going to upload. So, you please find out, use it in put it all this detail in an Excel file and you draw it, you will be able to find out what is going to be the at what price point variation in the ATF price this company is going to make profit from the long put and going to incur loss from the short call option. Okay. Now, let us focus on a contract called a volumetric production production payment contract or PPP contract, and this contract is this contract is nothing but a swap contract. In case of a regular swap contract, if you recall, the crude oil producer receives the fixed payment from every let us say 2 months. So, if both parties has agreed for a contract of 3 years and payment is made on the notional volume every 2 months. So, the payment or receipt happens at end of every 2 months. So, in case of a volumetric production payment contract, the payment to the fixed party receiver payment to the fixed price receiver happens at one go, that is beginning of the contract, that is the discounted present value of the series of fixed price to be paid to the counterparty, to one counterparty is paid by the other counterparty. So, let me take an example, then only this concept will be clear. So, you have a company called Chesapeake Energy Corporation CEC of USA, which entered into a volumetric production deal with a company called Barclays Capital. So, Barclays Capital and CEC signed a deal on May 2011. The deal was for 10 years and $850 million PPP. So, that means what? Over 10 years CEC agreed to deliver 180 billion cubic feet equivalent of natural gas at $4.82 per million cubic feet equivalent to Barclays. Barclays is going to pay a fixed amount of $4.82 per $4.82 per every billion cubic feet equivalent, and CEC will deliver 180 billion cubic feet equivalent of natural gas to Barclays. So, Barclays is going to pay fixed and CEC is going to receive fixed. So, instead of paying the fixed amount over 10 years, the discounted value of 850 million was given by Barclays to CEC at the beginning of the contract. So, Barclays became the fixed rate payer and the floating rate receiver. So, basically Barclays, what as part of the contract, CEC is supposed to deliver the natural gas to Barclays, not the floating rate, but deliver the natural gas to Barclays in the spot market, and Barclays can sell that natural gas in the spot market and realize the prevailing price. So, there is also another interesting dimension to this BPP contract. What Barclays did is that it did not keep this this deal in its balance sheet. So, it paid 850 million upfront to CEC, and simultaneously it did not wait for 10 years to receive the benefit from the crude oil natural gas it is going to receive from CEC. So, what it did, Barclays Capital split its future cash flow into, that means whatever natural gas it is going to receive from CEC, it issued 2 bonds or 2 pools, and the investors who invested in these 2 pools will be getting benefit from the price at which Barclays is going to sell the natural gas. So, these 2 pools were known as Glen Pool Oil and Gas Trust 1 and 2, and to sell these two debentures or trust to the individuals, this needed to be rated. So this is Moody's BPP rating detail. So these two instruments got rated by Moody's. I hope you are able to see the if you can see the screen. Rating action: Moody's rates Glenpool loan and notes deal backed by oil and gas volumetric production payment. So I don't want to go through this detail at this point of time. So you do read this one, and it's a very interesting way, the way the whole PPP contract was signed and managed by by both companies, that is your CEC and Barclays Capital. Now let's go to another interesting dimension of managing refining risk. Let's say that is standalone oil marketing companies are exposed to, or standalone refiners are exposed to price risk from both sides. That is, they are exposed to price risk from the input side as well as the output side. Let's say a refiner who does not produce crude oil, and this company, refining company, buys crude oil, refines it and sells the refined product in the market. Let's say when it bought crude oil, it had to pay a higher price, and by the time it refines the product and sells it in the market, maybe crude oil price has gone down. So his input cost is higher and its revenue is going to be lesser at this when the refining product price goes down. So this company is exposed to price risk, both input as well as output price risk. So how this refining company can mitigate the risk? On a standalone basis, this company would have entered into long futures contract crude oil as well as short futures contract on refined product, or it would have taken a long call on crude oil and long put on refined product if the company would have gone for option contract. So let me repeat, or let me write down. A refiner risk is crude oil goes up and refined product price goes down. So if this happens, this company, the refiner, is going to incur loss. So how it can mitigate that risk? If it goes for a futures contract, it will be buying long futures on crude oil and short futures on refined products, whichever refined product it is producing. Or using option contract, it would be going for long call on crude oil and long call on crude oil and long put on refined products. So with respect to this, now exchanges are offering crack spread contracts, so that the refiner can enter into one contract instead of entering into two futures contract. So what exactly is a crack spread? Let's go and understand this. So as the definition is given, crack spread measures the price difference between the refined product and crude oil product. So if you recall, we discussed when we were discussing about the soybean crush spread, we discussed about the crush spread. Exactly the same concept is applicable when we calculate the crack spread. So what exactly is a crack spread? Crack spread is the difference between the price of refined product and the crude oil. Let's take what are the different kinds of crack spread contract which is available at CME and how crack spread can be calculated. Please give me a couple of seconds. I hope this link opens. This link would have taken us to calculate the crack spread. Let me take this link to the sorry, let me take this link, copy it, let me see whether it is working, otherwise I can. Okay, in the meantime, it seems taking a little longer. So let's understand what do we mean by 1:1 crack spread. So crack spread contracts can be 1:1 or 2:1 or 3:2:1. Let's say let's take a we take 2:1:1. So that contract. So how do we calculate the crack spread? Let me check whether in case it has come in the meantime. No, it is not. So it is still. Okay, there is some problem with the internet, so let's not go into spending time. So let me show you how exactly this crack spread can be calculated. So let's go to 2:1:1 crack spread. So this how the crack spread can be calculated. So if you see, it says 2:1:1 means 2 crude oil contract, let's say 1 heating oil and 1 diesel contract, or 1 gasoline and 1 diesel contract. So how do you calculate the crack spread? So you will be have, let me give an example. So let's say you have a crude oil which is quoting at $49.60 a barrel, which is equivalent to 42 gallons, and you have 1 gasoline. So the price which is expressed in 42 gallons equivalent is, let's say, is coming to let's see, gallon, it's coming to, let's say, 44.25, and one heating oil contract, which is equivalent to 42 gallons, which is coming to, let's say, 50.75. So how can we calculate the crack spread? So it will be 44.25 plus 50.75 minus 2 into 49.60. So that is going to give us our crack spread. So let's say this exercise, which is you can work out, petrol spot price is US $2.30 per gallon, heating oil spot price is US dollar 2.40 per gallon, and crude oil spot price is $82.5 per barrel. So you will be able to, when you are finding out the crack spread, so 3 into or let me write down, it will be let's solve this exercise. So you have crude oil price is 82.5 and petrol is 2.30 per gallon, and heating oil is 2.14 dollar, all these are in dollar terms, per gallon. So what will be our crack spread? For 3 is to 2 is to 1. So we have our 2 parts of petrol. So when we are talking about, so 3 into 82.5 is our crude oil. So you will have $2.30 into 42 into 2 plus 2.14 into 42 is going to be price of the refined products. So let's call it A and this is our B. So A minus B is going to give us the crack spread. Now, how refiners can use this crack spread futures contract to mitigate the risk? So if a refiner is expecting the crack spread to widen, it can enter into the long spread, or if it is expecting the crack spread to narrow down, it will enter into a short spread position. So in case of a long spread, when you are taking a long position, you are buying futures contract in refined products and you are selling futures price in the crude oil contract. And in case of a short spread, you have a short position in refined product contract, refined product futures contract, and long position in crude oil futures contract. And as I have mentioned, these contracts, crack spread futures contract is not available in Indian exchanges. It is available at US exchange. So if you want to learn more about it and how companies are using CME website, you can visit and you can learn more about it. So with this we come to an end on today's session, and this also the last session with respect to the crude oil. And this particular commodity has taken a little longer than the usual what I thought the amount I will be covering, considering the variety of contracts available and the number of players. So I think it is worth discussing this particular commodity in detail, commodity and commodity derivative contracts with respect to crude oil and refined oil in detail. So what are the key questions? So without taking much of a time, I am just highlighted what are the different key questions at the end of this session which you should be able to answer. So I am not going to discuss each and every key question because we do not have time today. So I am winding up this session today, and in the next session we'll discuss we'll start discussing with different derivative contracts with respect to gold price. Thank you all of you, and as usual I end all session looking forward to meeting with all of you. Thank you all of you.